Hello and welcome back to the channel, where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze setups. Today, we're putting a very specific company under the microscope, CLRO Inc., ticker symbol CLRO. This isn't just a generic example, we're going to break down CLRO's unique situation using real-time data from our screeners. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. CLRO Inc., or CLRO, operates in the technology and communication equipment sector. With a market capitalization of just under $20 million at $19.07 million, it's a micro-cap stock. The company, incorporated way back in 1983 and headquartered in Salt Lake City, Utah, previously focused on professional audio conferencing, microphone, and video collaboration solutions, but currently does not have significant operations. Looking at its recent price action, CLRO has been quite volatile. Today, it saw a modest gain of plus 0.96%. Over the last 5 trading days, CLRO is up an impressive plus 11.33%, and stretching that out to the last 30 days, the stock has surged by a remarkable plus 133.23%. However, today's trading volume of 67,100 shares is significantly below its 30-day average volume of 6,438,226 shares, giving it a relative volume of 0x its average. Show chart, CLRO 30-day price action. What is cost to borrow and why it matters? Before we dive deeper into CLRO, let's quickly clarify what cost to borrow means. When you short a stock, you're borrowing shares from someone else, selling them, and hoping to buy them back later at a lower price. But borrowing shares isn't free. You pay a fee, known as the cost to borrow, or CTB. This fee is usually expressed as an annualized percentage. Why does it matter? A high CTB indicates strong demand from short sellers who are willing to pay a premium to bet against the stock, or a very limited supply of shares available to short, or often both. When these fees start to skyrocket, it's a huge red flag for short sellers, signaling potential trouble ahead if their thesis doesn't play out quickly. It's essentially the market telling you that borrowing these shares is becoming incredibly expensive and difficult. Why the stock is hard to borrow right now. Now let's apply that to CLRO. Our screener flagged CLRO Inc. because its cost to borrow fee currently stands a staggering 716.2% annualized. To put that in perspective, many stocks have CTB well under 1%. What's even more striking is the momentum. This fee has exploded, increasing by plus 611 percentage points over just the last 5 trading days. This rapid acceleration in borrow costs suggests a fierce battle. Furthermore, the number of shares currently available to borrow is incredibly low, only 15,000 shares. When you consider CLRO's estimated float is around 0.7 million shares, that's a tiny fraction of the float left to short. Our internal composite squeeze score, which factors in CTB level, CTB momentum, shrinking borrower supply, float size, and technicals, currently assigns CLRO a score of 50.5 out of 100. This combination of extremely high and rapidly increasing borrower fees coupled with a minuscule supply of borrowable shares against a relatively small float makes CLRO a prime candidate for our hard-to-borrow screen. Squeeze mechanics explained. So, what happens when a stock like CLRO becomes hard to borrow? Imagine you're a short seller betting against CLRO. You borrowed shares, sold them, and now you're paying that 716.2% annualized fee every day. If the stock price starts to rise, as CLRO has recently, your losses mount, and your borrow costs become excruciating. As the available shares to borrow dwindle to just 15,000, new short sellers can't easily enter, and existing ones face intense pressure. This pressure can force short sellers to buy back their borrowed shares to close their positions and stop the bleeding. This short covering creates buying pressure, which pushes the stock price even higher, trapping more short sellers, and leading to a cascading effect known as a short squeeze. It's a powerful feedback loop. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay extreme prices to stay short. Dilution risk check. Now, a critical factor for any short squeeze thesis is dilution risk. For CLRO, our check reveals a significant red flag. Recent SEC filings show a registration statements -1/-3/424B within the last 90 days. This indicates that the company may be preparing to issue new shares, either directly or through options/warrants. Why is this important? Even with sky-high cost to borrow fees and a tight float, if a company introduces new shares into the market, it increases the overall supply. This sudden increase in available shares can directly offset or even completely negate the buying pressure from short covering, effectively satisfying the demand and suppressing the stock price. It's like trying to drain a bathtub while the faucet is still running. On a positive note, we found no recent reverse split for CLRO in our look-back window. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For CLRO, given its current setup, here's what to keep an eye on. Firstly, continued monitoring of the shares available to borrow. Does that 15,000 number shrink further, or does it start to increase? Secondly, observe the cost to borrow. Does it continue its ascent, or does it plateau? Thirdly, pay close attention to CLRO's volume. Today's volume is a fraction of its average. For any significant short squeeze to materialize, we'd need to see a dramatic surge in consistent buying volume. Finally, closely track any news regarding the dilution risk we identified. How the market interprets or reacts to potential new share issuances will be crucial. Show chart CLRO volume bars. In summary, CLRO Inc. CLRO presents an intriguing case study with an extraordinarily high and rapidly rising cost to borrow of 716.2%, a very limited supply of borrowable shares, and a small estimated float of 0.7 million. While this setup often signals intense pressure on short sellers, the significant dilution risk flagged by recent SEC filings and today's relatively low trading volume are critical considerations. Remember, these are just data points for educational purposes, not a call to action. We're here to help you understand the mechanics. If you found this deep dive into CLRO insightful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments what other hard-to-borrow stocks you'd like us to investigate next.